Welcome. So, we will continue our discussion from the previous session, where we initiated talking about capital budgeting decisions based on various models. We have discussed about discounted cash flow, and we did not give the formula for present value factor. So, here it is, present value factor for annuity, meaning if you know that cash flow is equal amount every year and over a period of time, then rather than discounting individual entries to the present, we can actually estimate a factor and then multiply that with the equal amount that is happening every year, equal net cash flow happening every year. We get the total value of number of streams. For example, suppose you foresee that there will be 500 rupees of cash inflow, net cash inflow for say 5 years, and your interest rate or discount rate is suppose 10%. So, every year 500 rupees is coming in and discount rate is 10%. So, you want to know what is the present value of this recurring amount. Every year it is happening for 5 years. So, what is the present value of this total amount? So, the formula is here. There are only two variables. One is R, that is the discount rate, you call it interest rate. Another is the number of years, that is N. So, if you know the number of years and you know the interest rate in decimal, then you can estimate present value factor. So, for 5 years at 10%, the factor is 3.79078. Similarly, if you just substitute value of R with say 0.13, so 13%, you get a factor for 13%, 14%, 15%, and you replace N, rather than 5 you can put 10, you can put 20, and you get the factor. So, you can actually prepare a table of these factors and you do not have to estimate, you just pick up the value based on discount rate and number of years, you will get a value, pick up the value and multiply that with equal cash flow that is happening every year. So, 500 is happening every year, multiply that with 500. So, you get the total value. Here it is 1895 rupees, whereas if you add them up it becomes 2500. So, 2500 rupees is happening, inflow happening, but its present value is only 1895. Now, the flip side or the opposite side of that or inverse of that is, suppose you borrow some money and you want to estimate equated monthly installment or equated annual installment. Let us talk about annual installment first, because interest rate is normally understood as on annual basis. So, you want to estimate what is my installment every year if I borrow suppose 1 lakh rupees at say 10% rate of interest. So, I want to know annually how much I have to pay. So, here is the formula, it is just the inverse of that. Numerator comes to the denominator, denominator goes to the numerator, and you get a factor. Multiply that factor with the principal amount of 1 lakh rupees, you get annual installment that is to be paid for 5 years, and the entire loan will be repaid with interest. If you want to estimate, let us see the data. Annual installment factor is, the R value is 0.1, N is 5. Just substitute the data, you get 0.263797, multiply that with 1 lakh, you get annual installment, and that is 26,380 you pay every year, loan will be repaid with interest. Now, if you want to make it a monthly installment payment calculation, then the value of R will not be 10%, because it has to be on a monthly basis. So, what is the interest on a monthly basis? If interest for a year is 10%, for 1 month it will be 10 divided by 12, that is the interest rate. So, 0.1 divided by 12 will be the interest rate, and the period will not be 5 years now, it will be 60 months, 5 years multiplied by 12, because we are estimating on a monthly basis. So, it is going to be R is equal to 0.1 divided by 12, N is equal to 60, and the value factor comes to be 0.008361, multiply that with 1 lakh, you have 8,361, that is the monthly equal monthly installment you have to pay, so as to repay 1 lakh rupees completely along with interest. Now, suppose here is just a very simple example of estimating net present value. See, you have yours is a company called XYZ and you received a contract from another company where you have to maintain something, some of their equipment or something. So, you need some equipment to maintain whatever that is. So, your investment is about 2,50,000 rupees, your working capital requirement for maybe for fuel or salary to pay to the employees who are going to maintain, say 20,000 rupees. Then you foresee that after 2 years you may have to actually invest another 90,000 rupees for overhauling your equipment or something. It's just to bring in some kind of a twist in the whole issue, because in the future whatever you do in a real world situation, you will have many cash inflow, many cash outflow. So, that just to show that there may be cash outflow at some point of time. So, upgrading of equipment after 2 years is a cash outflow. Salvage value at the end of the period, end of your contract horizon, you are going to get back 10,000 rupees by selling the equipment. Then the contract value itself is 1,20,000 every year. Every year the company is going to pay XYZ company 1,20,000 rupees. So, after your this 1,20,000 is a net cash flow, meaning that the salary of the employee that you are engaging will be paid by the company, means wherever you are sending them for the work. So, you do not have any other expenses other than whatever, means you just receive 1,20,000 and these are the only data, and you expect that the business should return at the rate of 14%, only then you will accept it. So, should we accept it? The decision will be based on net present value. If the net present value estimated with a discount rate of 14% for the entire contract period of 4 years, if it is 0 or above 0, meaning positive, then you accept. If it is negative, you do not accept. 14% is the discount rate. So, just pause for a while, estimate and then move forward will be better. Which one is the answer? Find out. Answer is 28,230 positive. So, we accept the business proposition because it is positive. Here is another example, very quick example. Say the same contract now have initial investment is more, working capital is more, but there are other twists like annual cash inflow is 2,20,000 rupees. Then there is some net cash inflow, meaning that there is no other expense, all expenses taken together. Every year you are getting 2,20,000 rupees. Then upgradation after 2 years, then salvage value after 4 years, working capital is returned back. So, remember that working capital comes back always. And then here I just wanted to show that this 14% present value multiplication factor is estimated. So, for every year 2,20,000 rupees cash inflow is happening. So, you estimate that separately rather than estimating 4 cash flow separately. What is the present value in the first year, second year, third year, fourth year? You just multiply with 2.9 on 4, you get the total present value of the 4 inflow of revenue or say net cash inflow. It becomes 641,080 and you add them up, you get 42,820 negative. So, you do not accept it if your expected rate of return is 14%. Now, this is just an isolated case that you just estimate net present value. Suppose you have 2 business proposition, say one business proposition, your initial capital investment is 5,000, working capital is 5,000, whereas another business proposition where capital investment is 7,000 and all data are different. One business is valid for 5 years, another business will continue for 7 years. So, which is better? It is a complex situation. Even on a ballpark basis, you will not be able to say for sure that this business is better. You estimate the total profit or you estimate the cash flow, even then it will not be clear. So, you have to estimate the net present value, or you can do many things actually. We have already learned that you can make a cash flow statement, you can estimate the profit, you can compare their EBITDA, their return on equity, their return on investment made so far, all of that. And you can also do a break even point analysis, like break even point for business proposition 1, break even point for business proposition 2, and then see which one is breaking even early or where you have higher margin of safety, and you also estimate the cost indifference point, and you see cost indifference, where the cost indifference point is happening. Are you going to operate it beyond that point or below that point? Depending on that, you have to make a decision which one is better. Now, while talking about break even point analysis, I discussed about number of units, the number or the quantity Q. Now, quantity can be number, quantity can be in terms of tons or kilograms or anything. It is as good as in terms of rupees as well. So, how do you estimate break even point in terms of rupees of sales? So, you know the price, you know the quantity, multiply that, you get in terms of rupee. Now, just to elaborate that point, suppose you take this first business proposition number 1, where 11,100 is the sales. So, your contribution to sales variable is, say, contribution is sales minus variable expenses. It is not contribution margin, it is contribution. Now, contribution margin is contribution divided by sales or unit contribution. Forget about unit, just margin means its percentage of contribution. So, total contribution is 5,100, contribution margin should be 5,100 divided by 11,100 divided by sales. So, it is 45% or for something slightly more than that. And then break even, to break even you have to meet the entire fixed expenses, and fixed cost was 4,200. So, at what sales your total contribution becomes 4,200, that is the break even point. So, you know the percentage of contribution. So, you divide this 4,200, that is to be met with the contribution by 0.4595, you get the sales at which your total contribution is 4,200, and that is the break even point in terms of sales. Therefore, break even sales is equal to fixed expenses divided by contribution margin, which is nothing but 4,200, and then margin of safety is break even sales minus total sales, which is total sales minus break even sales, which is 1959. You can do this for the other business as well and compare. See, this comparison is not between an apple and an apple, because both are not of the same capacity. Their capacity is different, their total sales is different, their capital investment is different. That is why it is not a real, means you cannot right away make a comparison. What you have to do is, you have to now do a, first of all, a break even analysis and see what is the margin of safety. Suppose margin of safety here is on a percentage basis, total sales and margin of safety. So, margin of safety divided by total sales, if that is a great percentage, so you are highly comfortable. If it is marginal, nominal, say 10% or 15%, it is risky. So, whichever gives you a higher percentage of margin of safety is better in a way. It is not absolutely better, but in a way it is better. Then you have to do the net present value calculation and make a comparison. So, that assignment is given to you, estimate the margin of safety for the other business. Let us move forward with the break even analysis discussion. So, earlier we saw break even in terms of quantity, meaning the x axis is quantity. So, in terms of quantity it came. Now, let us see in terms of sales. So, it is almost the same thing, only thing is that the x axis is now sales and your break even point is the sales at which you break even, whatever we got 9141, and we are actually making a sales of 11,100. So, the difference between the two is the margin of safety, which was 1900 and something. Here is just the NPV calculation, which is 4,121 and minus 442. I have just put the break even here for the second business, which is 14,315 is the break even point, and 16,000 is the level of operation that we are doing. If you make a percentage calculation of the margin of safety, you will find that margin of safety for the business number 2 is narrow, whereas if you see the net present value of business number 2 is much better. Here it is minus 4,000, here it is only minus 400. So, net present value wise business number 2 is better, whereas break even point value wise number 1 business is better. So, you have to now make a subjective decision as to which one should we do. That will depend on many other discussion, which is not part of this discussion. Will maybe some other time we will try. Next topic is internal rate of return. Internal rate of return, meaning what is the rate of return at which the business is giving you profit. So, there is a business, now you know the cash flow. For net present value calculation, we started with a rate, because we know that there is a hurdle rate, we have to cross that. So, something like 14, 15, whatever is your expected rate of return. Suppose your expected rate of return is 16%, below 60%, 16% you do not want to take up a business, that becomes a hurdle rate, and you discount the future cash flow with that rate, and you see whether net present value is positive or 0 or negative. If it is negative, you decide that this business is not going to return me 16%, but less than that. So, you do not accept. Now, suppose you know the cash flow, you want, rather than having some discount rate a priori decided, you just see what is the rate of return rather than discounting at a particular rate. So, you estimate the actual rate of return at which the business is giving you money, that is called internal rate of return, and that is estimated by equating all the cash flow with the discount. You discount all the cash flow, and then the net present value is placed as 0, meaning 0 is equal to all the cash flow discounted to the present day. At what rate? That becomes the IRR, that is not known. That is what we are trying to estimate. So, you first of all you project the cash flow, then you write the same formula that we have given, like say for estimating net present value. Difference is, rather than net present value, now you write this is equal to 0. Now, you start on a trial and error basis, you take some data, take some discount rate, say 10% or 20%, you try with 10% and see what is the net present value. If it is positive, great amount of positive, that means the IRR actually much larger compared to that. So, you try with 20%, if you see it is coming negative, net present value is coming negative, that means it is between 10 and 20%. So, depending on the absolute value of the data for 10% and 20%, you will decide which side the actual value lies, and eventually suppose actual data is 15%. So, eventually you will come to that place when you will use 15% and you get net present value as 0. So, you decide that that is the internal rate of return. Now, trial and error is a tedious process, and you never know how many trials you have to do to really hit on the net present value to be 0. It is almost like impossible. You will get something like very close to 0. But there is a shortcut, that is, if the cash flow, like in the examples that we showed, this is a very hypothetical, and normally no business is going to return you equal amount of cash flow, but for simplicity we have assumed equal cash flow. But suppose you invest some money in a bank or for fixed deposit or something, or say you give the money to somebody and the somebody promises you, or say promises you some return, absolute return, say something like say 50,000 rupees per month or something. Suppose you want to decide about purchase of a property, say a big house or industrial estate. So, you want to buy that and then you want to rent it to somebody. If you know how much money at which you can rent it out, so you know that there will be equal amount coming to me every month. Now, in this kind of a situation where the cash flow is equal, you can use a chart, that is internal rate of return factor. You can use the factor and the chart, and then you can actually identify the actual internal rate of return. We will show it very soon. So, first thing is you have to place it is equal to 0. Second, you solve for that and you get IRR, and the third is that there is a shortcut for equal amount of cash flow. And the decision rule is, if the internal rate of return is say greater than or equal to minimum hurdle rate. So, if it is greater, obviously you accept, if it is 0 or equal to, you accept, but if it is less than hurdle rate, obviously you do not accept it. So, greater the IRR, better it is. Now, suppose you have 5 project proposals, you are trying to understand which one is better, which one is slightly less better, and you want to make a kind of a list, ordered list. So, you estimate the IRR. So, highest IRR comes first, then gradually the list is prepared. So, suppose we have this proposal that where you need to invest 4 lakh rupees at the beginning, and then by investing 4 lakh rupees, you are going to save 80,000 rupees that you are incurring now. So, that can be construed as income, meaning saving means income. So, you are saving 80,000 rupees, that is your cash flow, positive cash flow happening 80,000 rupees against an investment of 4 lakh rupees plus some working capital of 18,000 rupees. These are data, these are the data available. Next data is for internal rate of return. We do not use discount rate, but then we need to know what is the expected rate of return of the company. Suppose it is 13% and the machine is going to run for 10 years. So, the horizon of the estimation is 10 years and the hurdle rate is 13% and we have other data. Now, just for starting to, suppose you are using formula, the trial and error process, then you have to start from somewhere. If you start at 10%, you see the net present value is 73,565. If it is, since it is quite large value and it is positive, so you can guess that the actual rate of return, internal rate of return will be far more than 10%. So, next trial may be at 15%. You will find that it is not 73,000, it will be much smaller data, it may be even negative, a small negative. So, it will be closer to 15%, means depending on the absolute value. So, here is the formula, the same formula, only thing is that rather than writing NPV, you substitute that with 0 and then you take all the cash flow and the value of R will be based on trial, maybe 10% at the beginning and then gradually depending on the value, if it is positive move upward, if it is negative move downward, and n is the number of years. So, everything else is known, we just have to estimate. So, that is one way of doing it. This is one way of estimating, but if you know the regular cash flow, particularly in this one, we know that every year we are going to save 80,000 rupees and our initial investment is 4,18,000 rupees and life is 10 years. So, we know this data, and because it is equated amount, equated cash inflow, we can use that chart, and I am going to show how this chart is used. This chart is used with the help of internal rate of return factor, and that factor IRRF factor is equal to net initial investment, which in this case is 4 lakh rupees plus working capital of 18,000. So, it is going to be 4,18,000 rupees divided by annual net cash inflow, which in this case is 80,000 rupees. So, IRR factor is equal to 4,18,000 divided by 80,000 is equal to 5.22. It is actually 5.1216, but here it came to 5.22. So, let us see move forward. So, we have this data, number of period is 10 years, internal rate of return factor is 5.22. Now, we have to look at the present value of annuity table. This table looks like this. This is short form of the table, because of paucity of space I have just put it like this. So, we know that 10-year period. So, in this table you have to start from the period. Period is 1 year, 2 years, 3 years, 4 years up to 10 years. So, move downward, stop at 10 year and then move rightward. You have this data, the 5.22. So, you have to see where in this table I have 5.22. So, you start moving rightward, you hit upon this data 5.22 and then move upwards, say 4, and you see it is 14%. The top line, top row has the interest rate or return rate, it is 14%. That means this business is returning at the rate of 14%. So, IRR is 14%. Now, it may not always be so simple. Suppose you have a 9-year period and your value is 5.22. So, it may not be, you may not have a 14%, 13%, 12%. It will go straight upward where there is no rate. So, now you know that it is slightly above 5.33, but far less than 4.95, which is 14, and then 13 perhaps there will be a data. So, you know that it is between 12 and 13%. So, you can kind of depending on the using unitary method, you can decide at what place this interest rate will be. So, it is a movement going to the right direction, then moving upward to find at what rate this business is returning. That is what is internal rate of return. Now, suppose another example, very simple example. Suppose XYZ company can purchase a new machine at a cost of 5 lakh rupees, working capital is 21,000, that will save 1 lakh rupees per same sum, and then internal rate of return is estimated to be 14% the same way. It is just a repetition. This is another example, you just read that and find out whatever is the value, it is 12%. So, this is another example that you can practice. Other approaches to estimate or to make capital budgeting decisions. This is known, there are many methods actually. One very popular method is payback period method. So, if you see any project report, you invariably will see the break even analysis, the net present value, the IRR and payback period. These are the four data that will be provided, and a decision maker, whether it is an investor or a banker or say a co-founder, they will look at these data and then they will make a decision. Nothing is sacrosanct, it is not a golden rule or anything, but then in absence of any other data, people trust on this and they make all the decisions based on this. There may be a simple rate of return, that is simply just total income divided by total investment over a period of time. So, what is the annual rate of return without time value of money? Even payback period method does not take into account the time value of money. This is very important. Payback period method does not take into account time value of money, whereas net present value takes into account time value of money, IRR takes into account the time value of money. Let us see the payback period method of estimating whatever is the payback period and how we make decisions. See, payback period, if the annual cash flow is same every year, it is just investment required divided by annual net cash flow. Then you get the payback period, as simple as that. But in most cases it is not the same. So, when it is not the same, then you estimate the sum of the cumulative net cash flow over the years. In the first year, suppose cash flow is x1, in the second year it is x2, third year it is x3. So, you keep on adding this x1 plus x2 plus x3 till the time when you just cross the initial investment. So, initial investment is say 5 million rupees. So, suppose first year the cash flow is 1 million, second year cash flow is 2 million, third year cash flow is 2.5. So, 1 plus 2 plus 2.5 makes more than 5. So, within 3 years you are recovering 5 million rupees. So, payback period is 3 years, that is it, as simple as that. Let us take an example. Suppose you have initial investment of say 10 lakh rupees, there should be one extra 0. So, 10 lakh rupees is the cash flow, is the initial investment. Now, suppose your business has cash flow like the first column, 2 lakh rupees in the first year, 1,50,000 rupees in the second year, 1 lakh negative cash flow in the third year, 4 lakh in the fourth year and the like. and last one is 5 lakh rupees. So, we want to know when we are recovering the entire 10 lakh rupees from the business without considering the time value of money. So, we are not going to discount anything, we are going to take the absolute value. So, in the first year our cash flow is 2 years. Now, if you go for a cumulative approach, then first year 0th year there is no cash flow, or the negative 10 lakh rupees you can write it there. First year total cash flow is 2 lakh. Second year you add 1,50,000 with that, you get 3,50,000. Third year it is minus, so you deduct that from 3,50,000, you get 2,50,000. Fourth year is 4 lakh, so it becomes 6,50,000. And eventually in the fifth year you find that the total cash flow is 10 lakhs 10,000 rupees. That means it is becoming positive. So, when it becomes positive, that is the payback period. Here it is 5 years is the payback period. So, you can also take into account the 10 lakh rupees at the beginning and see whatever is the net cash flow year after year. That is it. So, eventually I think there is some mistake here, either in column number 3 or 4, it should be 10,000 rupees actually, either 10,000 rupees or 2 lakh 10,000 rupees. 10 lakh, then 8 lakh, then 4 lakh 50,000 is right, 5 lakh 50,000 is also right. You estimate. So, it should be 10 means the total should be same. So, likewise we can estimate. There are wonderful books in this domain, you can lay your hands on any of them. So, capital budgeting method use futuristic cash flow. Some word of caution actually, it is not really conclusion, uses future cash flows which are based on many assumptions. So, it is not, nothing is sacrosanct and there is no golden rule. Then cash flows are mostly probabilistic with different probability of their manifestation. You never know which one is going to. So, you may actually estimate based on optimistic, realistic and maybe pessimistic approach, and then you may have 3 different cash flows, 3 different net present value, 3 different IRR, you can estimate all of that. As such, both the macro and micro markets change over time and many assumptions may not sustain moving forward. Managers, entrepreneurs are increasingly applying the probability theory to better understand the likelihood of cash flow, thereby reducing the risk of volatility of expected return. You multiply your cash flow with probability and then eventually estimate the expected cash flow or expected net present value. Thank you very much.